$100,000 sitting in your account right now, and you had to choose between putting it into the Australian share market or Australian property, which one would actually make you wealthier over the next 10 to 20 years? This is the debate that splits dinner tables, dominates finance forums, and generates more passionate disagreement than almost any other money question in Australia. Property investors swear by bricks and mortar. Share market investors point to compound returns and dividend income, and most ordinary Australians, caught between the two camps, end up doing neither properly while the debate continues around them. Today we're settling this properly, not with opinions, with numbers, real Australian returns, real tax implications, real leverage mechanics, and real scenarios for real Australians trying to build wealth in 2026. By the end of this video, you'll know which option genuinely wins for your specific situation. Let's get into it. Before we compare the two, we need to establish what we're actually measuring. Because most comparisons between stocks and property make a critical error. They compare the wrong things. They compare a leveraged property investment against an unleveraged share portfolio. Or they compare Sydney's exceptional historical returns against a broad market average. Or they compare gross returns without accounting for tax, fees, and holding costs. We're going to do this properly. We're comparing $100,000 deployed in each asset class in realistic Australian conditions, accounting for leverage, tax, costs, income, and capital growth. And we're going to look at two types of Australian investors. First, Zoe, a 32-year-old marketing manager in Brisbane earning $90,000 a year who has $100,000 saved and wants to deploy it. Second, Marcus, a 38-year-old tradesman in Perth earning $85,000 who has the same $100,000 but different priorities and risk tolerance. Same money, different circumstances. Potentially different optimal answers. Let's start with the share market scenario. Zoe puts her $100,000 into a diversified portfolio, 70% Australian shares through a broad ASX ETF. 30% global shares through an international ETF. No leverage, no complexity. Just $100,000 invested and left to compound. The ASX 200 has delivered an average total return capital growth plus dividends of approximately 9 to 10% annually over the past 30 years. International indices have delivered comparable returns with different volatility profiles. We'll use 9% as a conservative blended return. In year one, Zoe's portfolio generates $9,000 in returns. Approximately 4% comes as dividends, $4,000 taxed at her marginal rate of 34.5%, including Medicare. Her after-tax dividend income is approximately $2,620. The remaining $5,000 in capital growth compounds untouched until she sells. Over 10 years at 9% annual return with dividend tax reducing the compounding slightly, Zoe's $100,000 grows to approximately $215,000 after tax. Over 20 years, approximately $430,000. The portfolio is completely liquid. She can sell tomorrow if life changes. She can add to it whenever she has spare cash. She faces no ongoing costs beyond a brokerage fee of approximately $10 per trade and an ETF management fee of 0.07 to 0.07 to 0.20% annually. The share market scenario for Zoe is clean, simple, and genuinely powerful over time. Now let's look at the property scenario. This is where the comparison gets fundamentally different, and where most Australians instinctively understand something that share market advocates sometimes underweight. Property in Australia is almost always purchased with leverage. Zoe's $100,000, as a 20% deposit, gets her into a $500,000 investment property. That property earns returns on $500,000, not on her $100,000. This is the transformative mechanic of property investing that changes the entire comparison. Let's run the numbers. A $500,000 property in Brisbane's growth corridors, purchased in 2026 at Brisbane's historical average capital growth rate of approximately 6% annually, grows to approximately $895,000 after 10 years and $134,000 after 20 years. Zoe's equity after 10 years, subtracting the $400,000 mortgage balance remaining after a decade of interest-only repayments, is approximately $495,000. After 20 years with principal and interest repayments reducing the mortgage equity of approximately $1,050,000. Compare this to the share portfolio result, $215,000 at year 10 and $430,000 at year 10 and $430,000 at year 20. The property wins, and it wins decisively because of leverage. Not because property is inherently a superior investment, because $100,000 in property controls $500,000 in asset. The leverage multiplies both returns and risk. But, and this is the critical but, property's leverage advantage comes with significant costs that most property advocates understate. Zoe's $500,000 Brisbane investment property generates rental income of approximately $480 per week, $24,960 per year. Her mortgage at 6.2% interest only on $400,000 costs approximately $24,800 per year. Her additional holding costs, council rates $2,000, water $1,200, property management fees 8.5% of rent $2,122, insurance $5,500, insurance $1,500 maintenance $2,500, total approximately $9,322 per year. Zoe's property is negatively geared, costing her approximately $9,162 per year in cash after all income and costs. She receives a partial tax benefit from the negative gearing deduction, approximately $3,151 at her marginal rate, reducing the net annual cost to approximately $6,000. Over 10 years, Zoe has invested an additional $60,000 in holding costs on top of her initial $100,000, a total cash commitment of $160,000. When we account for this total cash deployed, the effective return on property is more modest than the gross equity figure suggests. The share portfolio required no additional cash beyond the initial $100,000. Liquidity is also a critical cost. If Zoe needs $50,000 for an emergency, she cannot sell half a property. She either refinances, sells the entire asset incurring $15,000 to $25,000 in transaction costs, or borrows against equity, each option carrying its own friction and cost. So which one actually wins for Zoe and Marcus? The honest answer, as is almost always the case in personal finance, is that it depends. For Zoe, with a long-time horizon, stable income, no immediate capital access needs, and genuine risk tolerance for leverage, property wins on raw equity growth. The leverage multiplies returns in a way that an unleveraged share portfolio simply cannot match over 10 to 20 years. But she needs to factor in the additional cash commitment, the illiquidity, and the concentration risk of a single asset in a single suburb of a single city. For Marcus, a tradesman with a variable income, higher possibility of needing emergency capital access, and lower tolerance for the cash drain of negative gearing, the share market may be the stronger choice. The liquidity, the simplicity, the absence of ongoing cash calls, and the ability to invest incrementally as cash becomes available suit his circumstances better than a negatively geared property that demands $500 per month, even in months when work is slow. The comparison most Australians miss is not between the raw numbers of stocks and property. It is between their specific financial personality, their income stability, their capital access needs, and the time horizon they're genuinely committed to. Property wins the leverage game. Shares win the liquidity and simplicity game. The right answer is the asset class that matches the game you're actually playing, not the one that looks best in a spreadsheet built on assumptions that don't fit your life. And for the majority of Australians who have the discipline and the income stability, the genuinely optimal answer is to use both. Shares for liquidity, compounding, and flexibility. Property for leverage, tangible asset growth, and the forced savings mechanism of a mortgage. Neither asset class makes the other irrelevant. Together, they create a wealth-building portfolio that captures the genuine advantages of both. Which side of this debate are you on? Stocks or property? Drop it in the comments and tell me which one you're building right now. If this breakdown gave you a clearer picture of how each asset class actually performs for real Australians, hit the like button and subscribe for more real talk about money in Australia. See you next week.